Welcome everyone to this session where we aim to debate and discuss with key stakeholders on opportunities in Indian retail asset-backed securitization market for global investors. I'm Shomendra Ghosh, and on behalf of the Vivriti Group, I'd like to welcome you all and thank you very much for joining us. Let's start by taking a cold, hard look at some of the numbers to put this in perspective. We have a short deck up, please. Yeah. Next slide, please. So Indian ABS markets continue to lag peer set on absolute volumes, as you see here in a comparison with US, China, Australia, Japan, and South Korea. And in the chart below, you'd see that when looked at as a ratio of ABS volumes to GDP, we still lag these markets, despite lower GDP per capita. Next slide, please. Now, that said, the volumes have grown significantly through the last half a decade since overhaul of the securitization guidelines back in 2012, also buoyed by the strengthening of credit bureaus, massive growth and proliferation in retail lending, introduction of new asset classes, and stability in performance of these transactions. Housing and auto loans, and specifically commercial vehicle loans, continue to dominate over 60% of volumes, but the advent of other asset classes is notable. Investors, however, have largely been banks that have purchased retail assets either to meet their priority sector lending targets or to shore up their own retail lending portfolios inorganically. Capital market participation, including from mutual funds and offshore investors, has been low. Next slide, please. Yeah, so it's a similar story if you cut the data by originators, where if you look at by volumes, AAA continues to dominate. But owing over a period of time, because of all of these good developments, several originators have come to markets and have issued PTCs and are servicing them. This is very clearly visible when you look at the chart at the bottom, that lower rated issuers and lower rated issuances are starting to make up the numbers, if not the volumes as yet. Next slide, please. Now, talking of performance of Indian retail asset securitization, the numbers suggest that the downward rating transition has been infrequent, even in AA and A rated categories. Cumulative losses have been low, and the period can certainly now be called representative, because in the last decade alone, these asset pools and transactions have been through several disruptions, including crises, natural calamities, regulatory upheavals, extraordinary events. We're going through one, and also the issuers, rather the originators and servicers, have gone through their own liquidity crisis. Next slide, please. Continuing with performance, when we benchmark this to internationally rated securitization, and to our mind, the logical comparison for AAA rated PTC on the Indian scale is BBB internationally rated PTC. What we see is that the transition is very, very comparable, in some cases better. So what you see here, the numbers right at the top are of India, where we are comparing AAA to North American securitization numbers in terms of transition of transactions rated BBB, and the bottom is APAC numbers. So as you see, the transition has been stable, comparable, and in some cases better. Next slide, please. Yeah, so all of this sounds like a very large untapped opportunity, and it seems ripe for global capital to now take a serious look at Indian asset-backed securitization as an asset class. And to that end, we must debate and deliberate. Firstly, what do we think of the progress that we've made this far? Secondly, how conducive is the regulatory, the tax, and the legal environment for this asset class in India? And thirdly, importantly, what will it take for global capital to invest in Indian EBS? Back to the panel piece. So to do that, today we have a diverse panel of eminent professionals who have played very key roles in the securitization ecosystem. I'm an August company, and I'll take a few minutes to introduce them to you, please. I'll start with Amit Mittal. Amit Mittal heads Treasury at Tata Motors Finance Solutions. He's had a front row seat to Indian asset-backed securitization markets across cycles. His own firm has been an active participant in these markets. Amit, welcome. Keen to hear your perspective as an originator of assets and your views as market views as a treasurer. Welcome.
So thank you, Shom. Thank you for the invitation. Pleasure being part of this forum. Looking forward to have a very fruitful discussion and knowledge sharing with the panelists and the participants. So as we go along, we will discuss and debate on all the key points. So thank you.
Thanks, Arvind. Next, we have Arvind Rana. Arvind is a director at Fitch, specifically with the Asia Structured Finance team. He covers securitization across several key markets, including South Korea, India, Singapore, and Indonesia. Arvind, welcome. Keen to hear your views on from a rating standpoint and also how we fare vis-a-vis peers, given your global context.
Thanks, Om. Look forward to having a lively discussion and quite keen to be here. Thank you.
Thanks, Arvind. Next, I have Matt OSullivan, who heads APAC Origination at MNG Investments. He has held key positions in the ABS team over the last 15 years, researching, originating, and structuring private credits. Matt, welcome. Thanks for joining us. Keen to hear your thoughts as a global investor on whether Indian ABS appeals from a risk-adjusted return as well as from a sustainability standpoint.
Thank you, and I'm very happy to be on the panel. Very pleased to be here and be able to give a global perspective on the Indian market.
Thank you, Matt. We have Nilofer Lam, partner with ZB Associates with over 2 decades under her belt across securitization, capital markets, securities, funds, insolvency, corporate finance, and more. Nilofer, welcome. Thanks for joining. Look forward to your thoughts on how we compare to peers on regulation, quality of documentation, rights of investors, and more.
Som and panelists, thank you very much. And I'm delighted to be here and to engage in a lively debate, I hope. Many thanks.
Thanks, Nilofer. And we have Samip Parlota, a partner with PwC's tax and regulatory practice, specializing in financial services with close to 2 decades in advising clients on fund structuring, investments, exits, and more. Samip, welcome. Look forward to your views on the tax regime pertaining to bringing foreign capital to India, and specifically looking forward to your thoughts on what does India's own International Finance Center, IFC, in the Gift City hold for securitization markets. Welcome.
Thank you so much. Delighted to be a part of this panel and look forward to debating this very interesting topic.
Great. Thanks so much, everyone. We'll start the discussion, and I'll go to Amit first. Amit, as a stakeholder in these markets, would love to hear your assessment of the scale we have reached and the growth potential hereafter.
Sure. Thank you so much. So I think you have very well presented the data in terms of how the volume has been so far. I think it is quite easy to draw the analogy that there is good scope for the investor in terms of diversifying and looking for this as an investment. And definitely from the India perspective, there is a huge ample opportunity as we move forward to scale up the volume and make the investor understand the benefit of its investment. Now, just wanted to broadly touch upon before we understand the scale of what is going to be the retail lending and the opportunity. I think we all know, we have been hearing that, India as an economy is looking forward to work on a $5 trillion economy in years to come. It has its own challenges, But ultimately what's happening that the system around us, the department, the companies, the infrastructure are all gearing up to meet that kind of GDP number, which essentially means, one, there is going to be a large scale change in the terms of volume, the business, the opportunity that will come the way. Also, we have seen that in last 1.5 years, there have been a lot of hiccups in terms of pandemic, so the credit offtake have taken it a backseat. Now that we of late see after the pandemic 1-2 is over and we have seen a good vaccination drive, banks and non-banks lenders, they have all scaled up, augmented their capital to meet the demand that they expect. We have recently seen banks like SDFC, Axis Bank, or the non-bank lenders. They are all working on scaling up their growth capital, which means they are looking for good demand to come. With that, and now there are many new NBFCs, that is non-bank lenders, who are coming up because they expect good demand in terms of the retail lending that can come. Now, when I say retail lending, what it basically means is you have an opportunity to lend in the form of auto loan. It can be home loan. It can be unsecured loan. It can be business loan and many more such loans, which means there are ample opportunity in different segment of the retail lending. It basically now means that one have to look for diversification. Now, when it says diversification, it means there is a need, there is a opportunity available for the investors. We as a borrower, we always take the loan in the form of terms loans and all that stuff. But when we need to diversify, we need to look structured product like ABS structure. We have seen participants, which is largely public sector bank. Off and on, we have seen some of the capital market players or the non-bank lender, which basically means we need to look for investor, global investor who can be there as a long-term partner for all these lenders. And this is where we feel that global investors have a good opportunity to come and understand and invest in the ABS-backed securities. And we as a non-bank lender have huge opportunity to offer to the investor because, one, we are expecting the retail credit offtake to grow from here. And we can easily draw the analogy from what all happening recently in the Indian markets. So that's about it.
Thank you very much, Amit. Very pertinent points. No reason to doubt supply, like you said, and there's a clear win-win for foreign capital to come in and diversify sources of capital for Indian originators. Absolutely. Thank you. Arvind, I come to you. You cover so many markets. Tell us about the asset classes securitized in India. Are these enough? Are we missing some? Any parallels that you can draw to other markets?
Sure. Thanks, Om. So in terms of the asset classes, in terms of the and transaction structures, I think we have a long way to catch up with the peers. Indian markets are mostly dominated by priority sector targets, and the structures are around that, asset classes are around that. Of course, we saw that the new asset classes are coming up, but if you overall look at the asset classes that we have right now, we find that a lot of globally acceptable classes are either completely missing or almost missing. For example, CLOs are not there, credit card receivable securitization, CMBS is hardly there, credit-linked notes, personal loan securitization to a very minimal level in India, student loans, aircraft leases, marketplace lending. So most of these normal asset classes, most of the asset classes which are considered normal for other markets are almost missing or hardly any presence there. RMBS is mostly in India in the form of either lab loan securitization or direct assignments. I mean, I know there are transactions in PTCs also, but that's the largely the way of all the transactions happening there. Auto loans, what we call auto loans are truck loans. What others call auto loans are usually personal cars. They are the receivables related to the loans taken for personal cars getting securitized. Then other newer not newer, other asset classes like covered bonds, etc., are like almost absent. They have just started up. So overall, I think we have a long way to go, and I think we are moving in that direction. But the idea is both issuers and investors need to have will to diversify from priority sector targets.
Absolutely. Thanks. Yeah, sorry, please.
Maybe something about the structures also. In term, however, we look at the structures and in terms of some of the guidelines which are bit more comforting for from investors' perspective in India compared to what we see elsewhere. For example, skin in the game. It's largely either absent or 5% in in other markets. While in India, we see 10% as minimum skin in the game. So I think that's quite heartening and should give confidence to investors. In terms of seasoning requirement, I'm not aware of any major markets having minimum seasoning requirement. That's not to say that seasoning is not there. In some of the pools, we do see that, but it's mostly negotiated between issuers and investors. While in India, we have a very clear minimum seasoning requirement. So these are like positive sides of the same priority sector market. Yeah, thanks.
Thank you very much, Arvind. Noted your points. We have some way to go on asset classes and innovation, but from what you said, we have embedded the learnings from the financial crisis well in terms of skin in the game and not originating to sell. Good to know that. Thank you. Thanks, Arvind. Matt, I come to you. As a global investor looking at India as an allocation, what's your assessment of the scale we have reached in ABS in India? And also, how do we stack up from a risk-adjusted return standpoint?
Sure. Look, in terms of the scale, I mean, the slides that you had earlier on showed it fairly clearly that in a comparison to the larger markets globally, there's still a fair way to go. I think, clearly there's a good start and there is interesting product out there. I think as global investors, when we're looking at the potential to do transactions in India, there are places where we can find the right structures, work with the right originators who, have processes in place that we're comfortable with, and find the right asset classes and combine those to get good value. I think historically consumer performance has been good compared to the level of structural enhancements there are. So the kind of ratio of performance to enhancements compares very positively versus a number of the more developed markets, and the pricing can be attractive, though as some of the points you made in your slides earlier, hedging is sometimes problematic for global investors and access is not simple. I think further, just with the nature of the market, with the fact that it is developing, there's not as much strong historic data. It's not as easy to access comparisons as it may be in the markets that have been around and at scale for longer. It's very important to have done your work. So as a global investor, you need to really come in and have done a lot of work. For ourselves, we're working with a team on the ground in India and working with advisors on the ground in India. And it took us a good couple of years of working towards investment before we were comfortable with that.
Fantastic. Thank you very much, Matt. What I picked up, there's value to be found, but you've got to find the right kind of originators, the right asset classes. You have to go through your diligence and the findings. Hedging could be a challenge. Structurally, defaults versus the credit enhancement seems comforting, and there's price to be found. Thanks very much, Matt. Nilofer, love to have your views on stability of regulation guiding asset-backed securities markets in India since 2012, since the overhaul, and the same. Love to have your views too on what Arvind said. How do we compare to other markets on matters of seasoning and skin in the game?
Yeah, hi. So I think, I moved back to India about 10, 11 years ago, and I'd always done kind of securitization internationally, and kind of waited for this point to come in terms of the market to take off. And much of the corporate stress that we've seen in India has been corporate related. So I think that the ABS market actually truly now is a kind of perfect asset class for foreign investors to consider in India. In terms of the stability of the regulation, I mean, there's a very kind of key set of regulations which were in 2012, and they took into account much of what happened in the global financial crisis, right, in 2007 to 10. And so, as Arvind said, they brought into effect, the minimum, the MRR, so that the MRR is now basically here, it's 5% for loans up to 24 months duration and 10% for loans beyond 24 months duration. Plus there's a kind of minimum hold period as well. So I think that there's a lot of learnings which have kind of been brought into place to protect investors. Some of the revolving structures that have been challenging have maybe been because of the GFC as well. But largely the 2012 regulations have remained stable. In terms of obviously things like foreign investors being able to invest because we have capital controls, right, and therefore foreign exchange restrictions. Many of the issuances that have happened have come through what we call the FPI routes, that's a foreign portfolio investor route. And that has liberalized over a period of, time. There are still restrictions and some issues around that, in the sense that the foreign portfolio investors have, a single portfolio investor can invest basically 50% of any issuance. And there's also what is called the voluntary retention route, which allows them to invest 100%, but they have to lock up capital in India for 3 years. They can reinvest within that 3-year period, but I think there has been a liberalization, but this kind of structure does kind of continue. However, and I think others will come on to talk about it, the whole gift city and having structures through gift city can minimize issues there. So I think that's broadly what I would have to say on those 2 points.
Thank you very much, Nilofer. Noted your points that regulatory environment has been stable. We fare all right when it comes from an investor standpoint, when it comes to minimum holding period, minimum retention ratio. We need more efficient ways of bringing capital into Indian securitization. Yes, and we'll talk about Gift City. Thank you. Samit, coming to you. Love to hear your views on stability of the tax regime pertaining to securitization specifically since 2013 for domestic investors, firstly. And secondly, could taxation be more efficient for offshore investors coming through, say, the foreign portfolio investment, the FPI route, or coming through an alternate investment fund?
Sure. So I've been tracking this like taxation regime for securitization structure since the last 10 years. And obviously till 16, it's been a roller coaster ride. We had a moment or a black period for securitization in India, where the vehicles which are created for housing the receivables were taxed at the maximum rates in India. There were some negative precedents, and that blacked out completely the domestic market for securitization in India. 2016 is when the government has moved towards a clear pass-through regime. And I think last 3-4 years, some more amendments have happened, which now completely ensure that the pooling vehicle is a clear pass-through. There is no ifs and buts around it. It's directly taxable in the hands of the investor. So I think we have a basic regime in place now since the last 4 years, and it's been tested, at least on the domestic investor front. It's been pretty tested and no issues so far. I think some more work needs to be done to iron out the nuances from an investor taxation perspective, and especially the foreign investors. So obviously, if investors are coming through the FPI route, the treaty needs to be available, because most of the underlying income will be in the form of interest income, which again, if a treaty is available, it would be taxed at 10 to 15% based on the applicable tax treaty. So for foreign investors, obviously, as long as they're coming through a stable treaty jurisdiction, the tax should be efficient. Some more work can be done as long as the industry does representations. For example, a lot of these foreign investors wish to hedge the currency risk, and they do incur a hedging cost, which ends up being substantial. Currently, the taxation under the most of the treaties is on a gross basis, so you don't get tax deduction for this hedging cost. So I think the industry should represent to the government, and government has been clearly hearing the market in terms of making it more easier for foreign investors to participate in the Indian financial sector. So this is one point I think one should go about representing.
Absolutely. Thank you, Samip. So pass-through status of the PTC trust established, but routes of bringing in capital and being taxed efficiently, still some work to be done then.
Yes.
Thank you. And before I round up this bit, Matt, I want to come back to you once. While we spoke about how you see these markets from a risk-adjusted return perspective, would love to also hear how you rank these markets on grounds of sustainability and ESG, given that finally much of this money is going down to support livelihood in underserved markets and generating demand in the economy.
Sure. Yeah, the Indian market is quite attractive from an ESG standpoint. As you mentioned, there are a number of products that directly are focused on financial inclusion. For example, microfinance, micro SME. Those are the ones where it's very easy and very obvious to connect them. There are a number of the other products where there may well additionally be an element of financial inclusion within them. And those align well with a number of the UN Sustainable Development Goals, so such as the goal on reducing inequalities and the no poverty goal. And I think building on that, there are a number of potential investments that are addressing other UN SDGs, Sustainable Development Goals, such as there are a number of education products out there, so helping align with quality education. There are some products out there which can align with gender equality. So where there are female empowerment products, whether that can be put into the vehicles or into the transactions. I think there's even the potential to address other issues as well. So, for example, potentially in the future, there could be a focus on electric and hybrid vehicles in either the CV or the 2 or 3 wheeler space. So I think there is really already a very good opportunity for investors who have ESG targets or requirements to be deploying their capital. And there's the potential to grow that as well. So I think it's really exciting from that point of view.
Thanks. Thank you, Matt. Thank you. High overlap with UN Sustainable Development Goals. And if some of these markets pick up electric vehicles, that's a market to be watched for. Thank you. So we're going to spend a little time talking of performance of Indian asset-backed securities through the last decade. And I'll go back to Amit. Amit, we spoke about this last time, and we touched upon the resilience, right? We touched upon how the ratings have held up across crises. What would you attribute this resilience to?
So I think over the last 3 to 4 years, we have passed through a lot of crises. There were issues in terms of the issuers, how they have structured the ABS transactions. The credit enhancement, how they were placed, and there were problem whether it is a remote bankruptcy remote structure or not. I think over the period or after the pandemic 1 and 2, there have been a lot of changes and reform that have happened in the way credit bureau track all the performances of the underlying customer, how underwriting policies have changed to take care of all the nuances that have been faced in the system over the last 3 years. all this initiative taken over the period has, and the data that is available now in the market, all the transaction of PTC, which are done, I think that has helped one to understand what are the product or the loans which are strong enough to face all the issues in the market. Second, I think the way government has supported during the crisis by extending either the credit period or the DPD freezing or the guarantee that is coming from the government. This initiative taken by the government has actually helped track the performance, maintain the performance of the underlying loan which are being securitized under the ABS structure. I think this all put together has helped one for the investor to understand that yes, there are supports available, during this crisis time from the government, which help the ABS structure to pass through and without having much impact for the investors. So I think, some of the support which are provided by the government, and also important part of it, over the last 2 years, I think we can clearly say that this pandemic has made man separated from the boys. So we know what are the NBFCs which are strong enough in terms of governance, in terms of underlying policy, underwriting policies, and what is their collection mechanism. Because ultimately, giving loan is very easy, but how do we collect the loan and what is the mechanism through which that collection happens is very important. And which is where the investor in the ABS structure sometimes have the concern or skeptical about investing in the structure. So I believe the kind of collection mechanism that have evolved over the last few years, that has also additionally attributed to the performances of the ABS. So I think that is what I will attribute to for the kind of performance that we have seen during this period. Thank you.
Thanks very much, Amit. So quality of underwriting, the way transactions have been structured, as well as overall regulatory support, credit bureaus, a lot of things that have led up to this.
Yes.
Thank you. Arvind, love to hear your thoughts on performance of internationally rated Indian securitizations over the past decade and more.
Sure. So we have been present and rating internationally, assigning international ratings on these PTCs for maybe more than a decade. And quite happy to say that the performance has been very stable. And there are two reasons to that. One, the underlying loans are given for livelihood. The repayment is more, for the borrowers, repayment is more important than for a, let's say, a personal loan or a car loan given for a leisure. So that has been one factor. And another factor is about the fast deleveraging of these transactions. So these are the two reasons why transactions have held strongly. And as an example, during the last two major stress periods, or three, twice for COVID, so pandemic wave 1 and 2, and demonetization plus GST implementation. So the delinquencies in our pools rose 90 plus days past due areas increased by less than 1 percentage point, which may sound a little bit high from some of the developed markets, but considering the type of borrowers and type of pools, I would say it is much better than we would have expected normally. And the transactions have proved, if nothing else, but stable. The performance has been quite predictable. Even during the stress periods, we had rated transactions in December 2016, right after the demonetization was assigned. We rated transactions in March 2020, and none of these saw the delinquencies going through the roof or anything like that. In fact, the challenges that have come have been more on the structure side, more on the entity risk side. For example, the bankruptcy remoteness of assets was tested and successfully passed during default of one of the large RMBS originators of India. Not the pools rated by us, but still heartening to see that the principles of bankruptcy remoteness are respected in the market. And bankruptcy and liquidity was another challenge that came in with payment holidays of 6 months announced last year. But these transactions held through. None of the transactions had to go through any kind of default. Yes, the transaction structured moved from timely payment of principal to ultimate payment of principal. However, that is in line with most of the other peers or global jurisdictions that we see elsewhere. They almost all have ultimate payment of principal structures, so nothing that demerits India. In terms of liquidity or cash collateral availability, we saw that that one principle was being challenged, and cash collaterals held in the name of originator were not allowed unfettered access. Not to say that these are assets of SPVs or not, but that's a separate question. The timely access was questioned, and all our rated pools moved to cash held in the name of trust directly. Overall, I would say that these stress periods have given us a lot of confidence that the markets, the structures, the pools, everything is moving towards a more stable and more predictable behavior. Yeah.
Thank you so much, Arvind. You make some very key points. First, I noted that income generating loans, livelihood generating loans, adding to stability, asset pools tested across major crises. Your point on predictability, I note that particularly because what that means is one can model, one can budget for an eventuality. And the point you made around what's been tested through that difficult period of the PTCs of that housing finance company, which includes, to my mind, bankruptcy remoteness that you talked about, usability of the collateral, and I think we'd love to also hear the panel's views on backup servicer as we go along. Thank you. Thanks, Arvind. Matt, would love to hear your views on how easy or difficult is it for you as a global investor to assess performance of asset-backed securities in a market like India. Is it different from how you would do it in other markets? Are there repositories available? Do we lack benchmarks?
Yeah, thank you. It's not simple. It's not as easy as it is in the markets that have a longer time period. During the time that we've been working towards our investments and building our knowledge in the market, we certainly did find that there weren't as many easy comparable data sets as there are, obviously in the US and Europe particularly. You have data providers with very long history of data, easy comparison across transactions. The rating agencies have extremely rich data sets that are available with the data cut in all sorts of different ways, and there wasn't as much of that here. We did obviously get help from, found certain places where we could, worked with the rating agencies as much as we could, worked with platforms such as Create Avenue. But I think it's also, as I said earlier, not wanting to repeat myself, why we felt that it was so important to have, we have our team on the ground here who, obviously have local knowledge, and we're also working with local advisors. And with all of that, and bringing out what data we could, and with all of that, we could get to the position where we're comfortable to be investing. But it's not as straightforward as it is in other markets. And I think, for global investors to find it easier to move in here, that is something that could be looked to be improved on.
Thank you, Matt. Noted that's definitely room for improvement for us to be able to talk about how well or not well we're doing on performance. Thank you. Nilofer, coming to you, we definitely would love to hear your view on what's been tested through the last episodes of the housing finance company debacle and its impact on the PTCs, what we saw through. So principles of securitization, right? Bankruptcy remoteness, cash, usability of collateral, collateral backup servicer. What's your take? How do you read this?
Yeah, so I think Arvind alluded to this as well. And of course, about a year and a half, 2 years ago now, Dewan Housing Finance Corporation went bankrupt effectively. And effectively, I suppose that is the first time that true sale in the context of securitization has been challenged and kind of tested by the Indian courts. And I personally was in court for that hearing. So I kind of have the first-hand knowledge on that. It did take the judge kind of 2 turns to get it, if I could say it like that. But it ultimately did pass the test, and quite strongly so. So effectively what happened is that there was a potential moratorium on all payments, but that moratorium did not apply to all of the securitized debt and the pools that were being managed by Dewan Housing Corporation when they had kind of gone into insolvency. Now, subsequent to that anyway, there have been various amendments to the insolvency kind of legislation, broadly speaking. So the Insolvency and Bankruptcy Code, which applies when a company goes into insolvency, allows for 2 kind of options. One is the rehabilitation of the company, and the second is post that liquidation. However, there have been changes, as well as the existing code anyway, made it quite clear that assets being managed or being serviced now by any company that goes insolvent will not form part of the bankruptcy estate of the originator. So that is very kind of crystal clear in terms of the code and the rules and regulations that have kind of come out. And it does also specifically deal with the construct of a finance company being a servicer or a collection agent, where they keep that money, is the fact that they're doing this pursuant to a kind of servicing contract, that they've got to kind of ensure that the collections and the receivables are obtained. So I think we've really come a long way in the last, basically since 2019, because now there is a kind of statutory kind of mechanism that bolsters on to what was earlier there. So earlier what we had is, Transfer Property Act. We also have a Trust Act, which is very similar to the UK Trust Act. So broadly speaking, all of those, the building blocks were there, but it had never really been tested. Now it's been tested, and there's more insolvency regulations which have kind of come on top of that, which I think have made it kind of very clear and put it beyond doubt. So I think from an international investor perspective, that should add a lot of comfort, because it's not just to the regulations there, but there's tested, there's case law, and I think that that's very, very encouraging. In terms of all of the enforcement mechanisms, there is one mechanism which effectively allows international investors, which is not available to international investors, which is SARFAESI. There's another enforcement mechanism which allows direct sale of assets without kind of any intervention of the court. But given that we now have this insolvency framework, I think that's effectively what people are going to be using and taking over. One point just to note on that, I think that generally speaking, as a construct, backup services is still quite nascent here. I think that's one area that definitely needs to be developed more. We did, however, see that when Dewan Housing went into insolvency, there were a number of kind of market participants that kind of came forward to actually service assets and pools, because the administrator who took over needed that to continue. But I think compared to other jurisdictions, and my personal experience has been more in the UK, I think the construct of a backup servicer being embedded in the documentation, of entities being there who are getting pool data on a monthly basis as a backup servicer, I think that is one area that still needs to be developed. And I think that there's a lot of scope for the market to, have entities do that.
Thank you very much, Nilofer. Thank you so much. So it's firstly noted that it got tested. It's not a theory anymore. Much of these principles, the point you made on rights of offshore investors do not have remedy under SARFAESI, but the insolvency code is getting fleshed out. Your point on backup service are extremely well taken. That market needs to develop. There's recently been a case or two of unsecured loans where the PTC is seeing a backup servicer step in, but definitely in nascency, much more to be done, many more backup services needed. Thank you. Samit, tell us about the advent of new asset classes that you've seen through the past half a decade or so, and innovations that you've seen in structured finance over this period of time?
Sure, so one interesting thing about this market, and this I've seen more in the last couple of years, I think with innovative debt platform like yours, the market has not shied off from doing innovations, even though the structure may not be tested. Where there has been a need, I think market players are trying to innovate and come up with structures which address a particular hindrance in the regulatory or tax regime. I think I'll just give a couple of examples. There are obviously many, but I'll restrict to a couple of them. The first is the covered bond structure, and I think obviously because of the various regulations which get attracted to create a PTC structure, the MHP, MRR, and all these restrictions. The covered bond structure is something which has in the last couple of years got prevalent, although not fully tested probably from a bankruptcy remoteness perspective, but I think that's a clear thing which market has implemented. From a tax perspective, also covered, we do have some concessional rates available on bonds which are below particular interest rate of 12.4%. We have a 5.41% concessional tax rate available in those cases. So that's something which, from an offshore player perspective, a covered bond does offer. The second example is the replenishment structure, and I think that was to largely address the challenge faced by some of the FPIs, that if they come under the VR route, they need to keep the money invested in India for say 3 years. And because most of the pass-through certificates would start throwing up cash flows in less than 3 years, it would become difficult for them to redeploy that cash. So the replenishment structure also, I mean, and that was much before RBI came out with the draft guidelines that this is something which is possible. The market has tested it, and there have been structures where one could reuse the cash and redeploy in security subject in receivables subject to bells and whistles in place. So I think the market and the fact that market is innovating does show that there's a huge need to come up with structures, and I think that's what the market is doing.
Thank you very much, Amit. Yes, indeed, innovation on the cards, something new happening pretty much every year, and all of those are exciting. Thank you, Samit. With that, I'll enter one final round of question to everyone on the panel, and we would love to hear your thoughts on what you think could encourage global investors to look at Indian securitization more seriously. And please also feel free to talk about your outlook, trends you see, and opportunities that you see therein. I'll start with Amit. I have a specific question, and please add on to this. But you think originators would be more open going forward to making more granular disclosures at the contract level if needed, for example, to get international ratings or be more give more comfort to global investors?
So, Som, I think the way regulation have evolved in last couple of years in India, we have seen now that, for example, SEBI has become quite stricter in terms of when a new NCD is issued, you need to do a lot of disclosure, which was earlier not required. So similarly now RBI, or because most of the non-bank lenders have moved to India's regime, there are new disclosures which have to be made in public, and all the rating agencies have started asking so much granular information, and they are placed in all the quarterly report that they put up in the website. I think most of the NBFCs, non-bank lenders, have started becoming used to disclosing additional information. Even for that matter, when an ABS transaction is done and subsequent surveillance happen, I think the rating agency asks for so many information, and now which is made available to them, it is quite comfort for the non-bank lender to start sharing with the investor, because at the end of the day, non-bank lenders are looking for long-term partnership with the investor. It is not a one-time issuance that we are looking for. I think in today's time, I think it is quite comfortable for the originator to share the information, because that is what regulatory look for, and that is what gives comfort to the global investor. So I think we are absolutely comfortable, I'm sure. And as I mentioned earlier also, that after this pandemic 1 and 2, we have seen man separated from the web, which means a strong governance NBFC will be always happy to share more information with the investors. And so I think it's quite comfortable for the originator, and that should give the comfort to the investor going forward.
Thank you, Amit. That's heartening to know, and sure investors will take note. That's comforting. Coming to you, Arvind, while you talk, please do also talk about factors that you think cap the rating of Indian transactions. Country, bank account, commingling, anything else that you feel caps the rating.
Thanks, Sean. But before I jump into that, I would like to second the point about disclosures that Amit made. So we work with quite a lot of issuers in India. And so far, I have not seen any major issue related to data disclosures to rating agencies. When I don't monitor what they disclose in the market publicly, but for a rating analysis, I think this has been quite detailed, and in some cases more detailed than what we see in some other markets. And that also gives us confidence when we are making our own assumptions. Anyway, now moving to the part about rating caps. So in India, transactions are, according to our country risk criteria, are capped at ASF flat. However, none of the transactions so far I have seen going beyond BBB category. And the ratings are mainly capped due to account bank risks, and indirectly due to nature of transactions or nature of investments being priority sector. Investors, originators are not so keen to structure the transactions in order to mitigate some of these risks. And hence, if global investors come in and for actual investments and earning money instead of meeting priority sector targets, we see some of these issues being thrashed out. Some of the other parts that we foresee would be cleaned up are documentation, backup servicer, everybody talked about. A good part is that replacement did work in that Diwan housing example. And if backup servicers are part of the documentation, that should give some more confidence. Although from our perspective, the alternates are already there, so backup servicer does not cap the rating of the transactions at this stage. Another thing that we notice according for Indian transactions, I mean, when we talked about somebody mentioned replenishment or revolving structures. So revolving structures are again absent largely due to nature of investments. If they are meeting priority sector targets, none of the parties seem keen to look at long-term investments and mainly to meet their immediate priority sector targets. Some of the items I already mentioned briefly about documentation. So documentation does need cleaning up for sure. If you compare Indian documentation with some other markets, let's say, for example, Korea, similar transactions, you would see the documents are probably 10 times or more in volume in Korea, South Korea, compared to India. Indian documents are, like some of my colleagues say, are quite simplistic in nature. Which is good if all the players are regular, they know what these particular clauses mean and how these are to be interpreted. But for a new guy coming in, it makes it a challenge that to come to us the exact same conclusion every time. For example, in terms of treatment about prepayments and recoveries, the formula are not really thrashed out in the documents that I have seen so far, or how the servicer replacement event will be done. Documents would largely say that it will be done in a month, but how, who will take the action, what documents will be signed, what kind of data will be shared, none of that plan is part of the documentation. Overall, in terms of outlook, I do see all of these issues getting cleared up and the market moving towards more investment, real investment related to making money rather than making meeting their priority sector targets. And I think that's quite hopeful for Indian market overall. Thanks.
Thank you so much, Arvind, for sharing that. The first part of what you mentioned coming from you, that's very comforting, that you feel that the level of disclosure is good and comparable to other markets. That's very comforting. Thanks also for walking us through what caps the ratings. Thank you. With that, I'll move to Matt, an open-ended question actually. Overall, what do you think you mentioned some of the things, but what do you think will make more global investors look at this asset class seriously?
Sure. Look, I think the things that are preventing them look at it seriously are things that have been just mentioned by Arvind. It's around the potential cap on either public ratings, or even if you're doing the rating process yourself, because of concerns around the account banks and potential capital controls, which makes it hard to rate much above the sovereign rating. And that can mean that, particularly for some of the larger issuers and the cost of capital that they have from domestic investors, it's hard for that to be attractive at that rating level. I think that then kind of cascades to meaning it's potentially working with kind of second tier size issuers, and those often end up being bilateral investments. And then you have the access issues that we've talked about earlier on, so having to use FPIs and VRR, and that can be challenging. I think we talked about swaps being potentially an issue. For us, the challenge is that onshore counterparties often don't have high enough ratings for us to consider them as swap counterparties. So we're having to use offshore swaps, which obviously adds complications. So I think if there's a way to work to, and maybe it's working with some of the global investment banks to find ways of having higher rated from an international ratings standpoint of account banks and or swap counterparties, that would be helpful. However, that all sounds fairly negative. On the positive side, on the outlook, as we said, those things make it challenging, but don't make it impossible. We are investing. We see a very strong pipeline of opportunities to work on, invest on in India. And that's looking to work with, as we said, potentially good quality NBFCs in that second tier space where the risk return, given the kind of rating cap, may make more sense for us. Talking to fintechs on products specifically focused on the ESG side, because we think there's a lot of, as we've said, a lot of ability to invest sustainably in India. And then potentially working with some of the larger issuers on mezzanine debt products, where potentially working with them we can balance out that risk return basis. But that's I think something that's fairly new to start looking at.
Thank you, Matt. Very good to hear that you're looking at this as potential. Your point on hedging, very well noted. That's resonated with us all. Thank you. Nilofer, your thoughts on what could make things better, what could encourage more capital flowing in. Would love to have your thoughts also on potential of listing PTCs, pass-through certificates, and also technically what makes taking a swap contract for a trust in India challenging, a PTC trust specifically. Over to you.
Sure. So, I think SEBI came out with listing regulations for PTCs a long time ago. It was like 2014 or 15, I think. And really, we haven't seen many listed issuances. I mean, that now our listed issuances probably in the last year or 18 months. But I think just the volume of listed issuances is probably way, way less than what you would see in any other jurisdiction. And I think originally, my understanding is at least was that a lot of the information that was required to kind of be disclosed was sometimes a a prohibition from an issuer perspective, because they could do a domestic direct assignment with a bank or a PTC issuance, and the bank didn't necessarily need it listed. Now I think that's changed, and there are many more listings that are happening. And I think that also is good, but needs to probably be more. And that also leads into the point of disclosure in the OC, because whilst I take Arvind's point of obviously in terms of disclosure to rating agencies, I think just the general documentation, and OC in particular, could, or the OC equivalent, what we call the information memorandum, could be a lot more robust in terms of all of the pool data and assumptions and downsides, and all the information that is given. Part of that, of course, is backup servicer. Other parts that could be much more detailed, I think, compared to the international documentation, is things like your priority payments and how payments get calculated, how they get paid out, etc. Things like that. Also formats for sharing of data, etc. So I think that all of it's completely achievable. It's just a question, I think, of doing and changing kind of what we have to probably meet the international investors' requirements a little bit more. In terms of swaps, the PTC trust which is the issuing entity for the pass-through certificates, which are then subscribed by, say, foreign portfolio investors. That is an Indian entity, obviously, the trust. And the FPI entity kind of has to invest in rupees, and the PTC trust has to issue a rupee-denominated instrument. So one difference, of course, is that PTC trust cannot enter into an FX swap because they are basically not paying dollars, right? They're not receiving rupees and paying dollars. They're kind of receiving rupees and paying rupees. So to that extent, that's probably not workable under the current framework. Obviously, what would be workable is that the FPI entity may enter into a swap itself, but that may have other issues in terms of it may not be a perfect hedge in terms of being able to quantify the prepayments or the defaults and therefore the timing of the amounts, and there may be over or under hedging. Also maybe the cost of hedging, because it may be not that common, may make it uneconomic. I know that for other types of instruments, obviously people have used the NDF market overseas. So I suppose that's one option, but other people, on the panel will have a better perspective on that than myself. But yes, I think for the PTC issuer itself to hedge with foreign currency is currently not permitted. And some of the issues again around VRR that everybody's discussed, and FPI, and what percentage can be subscribed by the FPI is an issue. I think part of all of that whole issue will now go with people as they start to move to AIF funds in Gift City. Some of those issues will go.
Absolutely. Thank you very much, Nilofer. And interesting, you made that point about how documents need to be more specific about priority of payments. Last time this year, there was a draft set of guidelines released for consultation, which focused on this point. One of those points was that we have to be much more clear about how payment waterfalls or payment priorities are defined in a prospectus. And thanks, you lead us on to our next point, which I'll request Samit to talk about, something he's been very coldly involved in the development of, which is India's own International Finance Center in Gift City. Samit, please tell us about it. What does it solve for some of the issues that we talked about today? How does it, why does it make sense for investors to use that as a route of bringing capital into India?
Sure. So I think what the government and the IFSC authority, both of them are making very strong efforts to build a zone in India, which is housing offshore financial services. So today what is happening is all the financial services interfacing India are externalized in various offshore countries. India wants to bring it back, that you be in the homeland and do the investments in India through that particular homeland. And for that, they've given a lot of incentives to the structure which is set up in the IFSC zone. So one of the structures which could be used for subscribing to pass-through certificates is creating a AIF in IFSC zone, where the investors from various jurisdictions offshore could pool their monies, and the IFSC zone AIF in turn invests in the pass-through certificates. Now, what has been provided is that any business income earned by the IFSC AIF from the securitization or pass-through certificate activities, that is zero tax. There is a tax holiday available to the IFSC AIF on that. So that could provide a very clear structure, a complete tax certainty on the way the whole structure will be taxed. And at the same time, each of the investors don't need to get into FPI registrations and all. It is all aggregated at the IFSC AIF level. So from a compliance perspective, also it reduces the burden of the investors. So I think we have started seeing the activity picking up in IFSC last couple of months. A lot of AIFs have made a beeline for getting their funds registered there. And I would expect in the next 1 year we should start having PTC activity also from that particular zone. So I think that is one thing definitely to watch out for.
Thank you very much, Samir. Promising indeed. And also by pooling cash flows, having the ability to reinvest might just also make hedging a little simpler.
Correct.
Plus the fact that it's located offshore. Yeah, promising indeed. Thank you. Thanks for that. No, thank you everyone on the panel so much. This was very exciting. We'll open the floor for several questions which have come by. I just don't know how much we've overshot our time, but there are questions and we'd like to take some of them. I'll route some of these across to you. Anything that you'd like to say in addition to all that we have discussed, please feel free. I'll start with Matt. There's a question for you. The role of ESG ratings in determining the attractiveness of investments for M&G.
I think the challenge with ESG ratings is that there is no kind of standard yet. There's a number of different systems being put forward by different people. At M&G, we have our own internal processes on how we assess ESG. And then in particular for our Catalyst Fund, our new kind of flagship ESG and Innovation Fund that we launched at the beginning of the year, we again have a even more enhanced ESG process. So I think really it's something that we do ourselves, much like M&G has been doing its own internal credit ratings for a very long time. So as of yet, I wouldn't say that there are external ratings that we're particularly focused on, but with our internal assessments that we are.
Thank you. Thanks, Matt. Nilofer, there's a question for you. Top 2 changes required in ABS documents that are not available in domestic ABS documents.
Sorry, could you repeat that? Two changes that are not available.
Yes, 2 changes that are needed to the way currently ABS documentation looks like in India. So, what are the 2 changes you'd make to the way ABS legal documents look like?
So I think first of all, probably more disclosure in the OC, as I'd mentioned earlier. Secondly, I think Arvind made very valid points, and I'd 100% agree with that in terms of backup servicer, transition of data, even having a backup servicer agreement up front, right? I mean, we don't have it here, but offshore you would expect that to be signed up, a fee paid to the backup servicer from day one. So I think all of that. Third, I think priority of payments and how that would work as well.
Thanks, Nilofer. Arvind, anything to add to that? Going across to you, same question.
Okay, I have a bit longer list. So in terms of the treatment, then nowadays people have started talking about various triggers related to performance. So those items need to be thrashed out, like, how will that formula be available? As a comparison, if you look at any of the global, swap agreements, they will have perfect formula given at this rate, this will be the collateral amount. Same goes for delinquency. If it needs to be 2%, how will that be calculated? What will be in denominator? What kind of loans? So a lot of details are missing.
Right. Thank you. Thanks, Arvind. A question for Samit. Samit, have you heard about lower withholding tax for listed securitization transactions, similar to what is seen for listed bonds?
Correct. So I think that's a good question. So we do have for bonds a special tax regime where one could get a lower tax rate of 5% if the rate on the bond is 12.4%. Unfortunately, that is not available for pass-through certificates, and that's why I mentioned that. I mean, some of these transactions also have happened as a covered bond to get that treatment of 5.41%.
Thanks, Amit. Amit, there's a question for you. Top 2 recommendations to the regulator that would make ABS more attractive for issuers, for originators.
I think one definitely this clarity on the hedging side of it, which is creating nuances for the investors. Second is, I think maybe the FPI rule, it can be relaxed. We have these 3 years issues and VRR issues and all that. I think these are the 2 things which I will look forward to, from the ABS perspective, originator perspective.
Great, thank you. Thanks, Amit. We've got several other questions, but I don't think we'll have the time for all of this. We'll compile the questions. We'll make sure we respond to all of you. But thanks for sending those in. Panelists, I would like to thank you again very, very much for your participation. It was absolutely great discussing this with all of you, getting your thoughts. Thanks for your time and the participation. And look forward to many more. Hopefully, this is just the start of many more that we do on this topic and others. Thanks for your time, everyone.
Thank you, everyone.
Thank you.
Thank you.
Thank you.